In this video, we have Laura Spandrio, my personal tax accountant, and she's going to be talking about the new tax bill with Trump and what it did differently for real estate investors. You're going to want to hear this. It is almost an hour of pure content. You're going to really enjoy it and learn a lot. I just sat through the event and I learned a ton, and I can't wait to share it with you. Without further ado, Laura Spandrio.
Share her with you today. I've pushed a lot of business her way because of what she's done for us in our company over and over and over. And the best thing you could ever hear about her is that everybody that I've ever said you should go and use this person for your accountant, they've all been extremely happy, and they've all said that she's better than anyone that they've ever worked with before, and they've been in the business for years and years and years. Is that true?
Yes, and I'm blushing.
So, with that said, please give her a warm welcome, Laura Spandrio.
If you haven't recognized my last name, yes, I'm the wife of Tony here. So we together have successfully been in a lot of areas in real estate, and it's our opportunity now to give back and to share with you and share our knowledge. My passion, my strength is accounting and tax, and so that's where I can help other investors grow their business. So who here thinks that the tax code is fair? Is it fair? You're right, it is not fair. But you know what? The people that gain from the tax law are us. We are the winners. Us small business people, real estate people, we're the winners of this new tax law, or the old tax law, but there's going to be even more benefits in the future on this. But for me, my background, most importantly, I've got some credentials, but most importantly, I am a co-real estate investor. I know your business. I understand. And my husband keeps me busy, so we got a lot of deals going. I also am a QuickBooks Pro advisor, and I also now use a new software called Xero. Well, it's not new; it's been around for a long time, but that's the one that I recommend, and I'm pushing Xero software to use instead of QuickBooks. Got it? All right. So the new tax law that came out December of last year was the Tax Cut and Jobs Act. It was the biggest tax change in over 30 years. So there's a lot of new things that are happening this year that will greatly affect you guys. And that's what I'm here to share with you. It is, in fact, really a lower tax bracket. So on the next slide, I'll show you here. It's kind of hard to see, and I understand, but last year we had the 10% bracket, 15, 25, 28, 33, and 35% tax brackets. Well, now the new tax law, we have 10% tax bracket, a 12%. So if you were in the 15% last year, you're now in a 12%. 25% to 22%. If you were in the 28% tax bracket, and this is taxable income, not your earnings, but the taxable income after deductions. If you were here, you could be either in the 24%, the 32%, or a little portion of the 35%. So it's more important, and this is single. This is just single. So it's real super important to figure out how to maximize your deductions to get into the lower tax bracket. This next chart is for joint filers, so if you're married filing jointly, these are the numbers. It's the same concept, but the numbers are a little bit bigger. So the biggest number to really pay attention to for married filing jointly is $315,000. That's a magic number. Keep that in mind as I go through the rest of the presentation. For a single, I'm going to go backwards. For the single, it's $157,500. So I'll expand upon that. But the first part of my presentation I'm going to go over items that affect everybody, whether you're in business or not. So we'll touch on that briefly, and then I'll go into the benefits of the real estate side, because all of us have our personal side of things as well as the business side. So single joint. Okay, the standard deduction is greatly increased. So in this column here is the new standard deduction. So if you're single, the standard deduction is going to be $12,000. Married filing jointly, 24. Head of household, 18. Married filing jointly is 12. So last year, say married filing jointly, it was $12,700 for the standard. So it's going to double. So what does that mean? It means that if you've itemized in the past and your itemized deductions were $24,000 or less, then you're going to take the standard and you're not going to itemize your home mortgage interest, charitable contributions, medical, anything like that. It's just going to take the standard because that's going to be higher. So you still take the higher of your itemized deduction of the standard. So if you, last year, how do you know what to do for this year? If last year your itemized deductions were about $20,000, and that's on your personal side, I'm not talking business, I'm talking just the personal, which is your state income tax, your real estate tax, your home mortgage. Those itemized deductions, if they were about $20,000, continue keeping track of all of those receipts just like you have in the past. But going forward, if you were under that threshold, you no longer need to keep receipts for your charitable contributions, your real estate taxes for your personal residence, or medical expenses, any of that. So, because your standard is going to be higher, so you take the standard. That's where they think that it's going to be simpler. Yeah, right. Yeah, that's right. So, in addition to limiting the itemized deductions, there's an area in the tax return. I'm going to skip over to this page here. In this section of the itemized deductions, there's the state and local taxes, real estate taxes, your personal property taxes, and that's like your auto registration when your accountant asks you for your auto registration to deduct. That's where it would go. But now that deduction is limited to $10,000. You can't take more than $10,000 in that whole section. So that's going to limit a lot of people. It's also going to limit a lot of people in the New York area, California area that are paying high property taxes. Okay, limited to $10,000. So other itemized deductions that are no longer available to us at all is casualty losses. And this really hurts. It does apply to federally declared disaster areas. So when Florence hits the coast and the president declares that a federal disaster area, all of those people will be able to claim casualty losses on their homes. But if you were, say, anywhere else and your home got flooded, not because of this thing, you don't get to deduct the casualty losses at all. So it's pretty disturbing to me. Home equity interest for any loans after 2017. So if you took out a home equity loan this year and used it to pay off credit cards, that interest is no longer deductible. Okay? If you have an existing loan, then it is deductible. You can deduct the interest on an existing loan that you had for home mortgage interest, home equity interest. Moving expenses are no longer deductible. You can't take any more moving expenses. If you have a W-2 job, yes, go ahead.
Home equity interest is different from your first mortgage.
That is correct. Right. This is a second home or home equity. Your first mortgage is deductible. Yes. Moving expenses is no longer employee business deduction. So if you are a W-2 employee and you incur expenses for your employer, like airline stewardesses, they incur a lot of hotel charges, meal charges that they have to pay out of pocket Well, they used to be able to deduct that cost, and now they can't. Stewardess, truck drivers, they're greatly affected by that law. And then I went to a seminar this last week and said, well, here's a tax strategy. You quit your W-2 job and sign on as a contract laborer. The IRS is onto that. And so they're gonna knock that down. If that was a situation that you did this year, better be careful with that. Make sure you have real good solid contracts in place. And your tax prep fee is no longer deductible either. As a person. Now your business, the tax prep fee is a business expense, and that's deductible. Okay. So this is an example of all the changes that are going to be on this itemized deduction. Medical expenses, I'm not going to go into it further, but medical expenses will be affected. Taxes are affected. Your home mortgage interest. Now, those of you in here who have $1 million house that you bought this year, you can't deduct all of the mortgage interest. You can only deduct the interest that's on $750,000 of that mortgage loan. So that's a big one there. Charitable contributions are affected because you can now actually claim more of your charitable contributions. Because it used to be limited to 50% of your income. It's now limited to 80%. So you're good there. No portion of the employee reimbursements are reimbursable. So, okay, other things that are gone this year is the exemptions that you have on your tax return. And after reviewing this with a lot of people, it's like, well, what are exemptions? And it's the number of people that are on your tax return multiplied by whatever rate. Last year was 4,050. So if you had husband, wife, 2 kids, you get a deduction of 16,000 something. That's gone, completely gone. And in replace of that is the double standard, or the increase of the standard deduction. Alimony deduction, if you pay alimony, it used to be that you can deduct that as an expense. And likewise, alimony income, if you receive alimony income, you had to pay taxes on it. But any divorces after January of 2019, the person paying the alimony will not get a deduction, and the person receiving it will not have to pay taxes on that income. Why? I don't know. And they just made that up. Other good stuff is that even though the exemptions have gone away, this is actually sometimes a lot better. The child tax credit, instead of it being $1,000, you're going to get a $2,000 credit for each of your kids, okay? Up to 17 years old. So what do we do with those kids that are 17 years old? We only get a $500 deduction now. So, business tip on that is instead of having them as a dependent, have them as independent, pay them $12,000 a year, have it a write-off to you, they don't have to pay any taxes. Something to think about there. All right. Business deductions. This is the most confusing area. And by the way, we've only had one question. As I'm talking, if you have a question that comes up, please holler. Yes.
Just go back to that second mortgage, right? If it's a revolving, right, and say it's a $30,000 limit, and then you spend it, and then you buy it down, and you spend it. So is that interest still deductible, or is it expenses after 2018?
It still is deductible because you've set up the loan prior to 2017.
Okay.
Yeah. And likewise, if you use that HELOC, that's a big strategy for us investors,
right,
is use that HELOC for your business investment. That business investment is going to deduct it 100%.
Right. Okay. Perfect. Thank you.
Yes.
So even if there's no first, your HELOC is effectively your first. It still doesn't matter. That doesn't change it.
It doesn't change.
Okay.
Good question. Okay. This part is really confusing to a lot of people. Oh, I'm sorry.
That's all right. I had a question about, so you said on the children, you pay them $12,000, they don't have to pay tax, so they pay are you talking about a 1099 or a W-2?
Yeah, please. That's a very good question because it depends on your entity structure. If you're an S corp, you need to have your employees on payroll and pay them a payroll, and you have to withhold Social Security taxes. But if you're like a partnership or sole member LLC, then you can pay them 1099. Okay.
The advantage is you don't have to pay the FICA.
Correct. And they don't have to pay the taxes on the $12,000, and you can deduct it as a deduction of that $12,000. Yeah. So even if you're an S corp, and say you're in the 28% tax bracket, paying your kids the $12,000, plus you have to pay the self-employment tax or the Social Security taxes, which total 15% ish, then that is a deduction to your business.
Right.
So it's all good.
What about your kids that are like right at that 17 and they're turning 18? How do they get their account this year?
If they are 17 and older, they get the $500 deduction. If they're less than 17, it's the $2,000. So if they're 17 now for this year, they only get the $500. Okay. Now all of this is real new, so I could be mistaken. So we're learning a lot of information. This is all new stuff. Yes.
So if the kids are working, does that negate any of their tax credit of $2,000? So if they're earning an income and they're under 17, you get a tax credit of $2,000 for a child. Does that income offset that $2,000 credit?
It depends on your tax bracket. So it all depends on your tax bracket. Their tax bracket could be either 0, 10, or 15.
You're still going to get $2,000 regardless of what they make. Is that correct? For a child?
For a child.
Yeah.
Okay. Well, it gets
More complicated.
It gets complicated. So anyway, moving on. Meals and entertainment is a big thing. Go ahead.
So I can hire my grandson and pay him the salary, and I can deduct it, and then he doesn't have to pay taxes on it, right?
You got it.
And neither do you.
Neither do you. Meals and entertainment. A lot of people hear, meals and entertainment, we can no longer deduct that. But the entertainment piece is gone. We can't have fun anymore. That means a lot of, Broncos tickets or golf outings, things like that are no longer deductible. But the meals relating to those events are still deductible. And there's a lot of confusion with that. Meals are still deductible for your business purposes. So you can, there's no limit. Well, the limit is whatever the deduction is. You put that on your books, and the tax return will take 50% off of that. So you still only get a 50% deduction for all meals that you take. And so you can have meals with employees, meals with clients, meals given for client and promotional. And then there's the fringe benefits. So the fringe benefits is, I buy coffee and snacks for my office staff. So I put that into office expense. It's kind of a de minimis. It's so small that I just put it in as an office expense. But what I tell my real estate folks is that when you have clients and you're selling a house, you can take your clients out for dinner and wine and dine them, and it's deductible as a deductible expense. But you can't, after the closing is done, go and celebrate. So afterwards, you can go to dinner and then give them advice about moving in or moving companies or whatever. So you just have to document on your receipts what business purpose you had for your expense.
So you're you have closing and then you give a gift.
Okay.
Is that gift deductible?
Yes, but the sad thing about that, gifts being taxable, is that it's limited to $25 a person. As a real estate agent, if you sell a house for $1 million and get a gift for $25, that's kind of a. But it is limited to the $25, but it's per person. So if you have, the husband, the wife, 2 kids, now you're at, $25 times 4, and okay, add in the dog. So there's another $25. Then you can increase the deductibility of that gift. So
you're doing a party 90 days after the closing. That's not really allowed. Housewarming parties, things like that.
You have to have a business purpose for that party. So all you have to do, have a party, stand up, give a quick presentation, 3 minutes, go down. Then it becomes deductible. Yes.
Is this business purpose?
Absolutely. Absolutely. You are here. This is continuing education. Okay? So this meal is, you still have to put it in as meals and entertainment, or meals expense, not meals and entertainment, but meals expense. And you're here for a business purpose. The health insurance what's called individual responsibility penalty. If you don't have health insurance, your tax person has to give you a penalty on your tax return for not having health insurance. Well, you still have to have health insurance, but the penalty goes away after 2019. So in 2018, the tax preparers still have to put a penalty on your tax return for not having health insurance. So that, how many people will really continue to have health insurance? So with all of those changes, if you're a W-2 employee, it's really, really important to really watch your W-4, review how much is being withheld from your taxes, your W-2 paycheck, because your paychecks probably went up a little bit this year if it was the same. Or, if you had the same salary, you would have noticed that your withholding was a little bit less. So if you're expecting a refund, you're not going to get it. If you're expecting to pay just a little bit of taxes, you might be surprised that you're going to actually owe more because not as much is being taken out of your paycheck. Because this is the whole idea with the IRS. They want to put more money in your pocket so that you spend it so that it increases the economy. So that's the whole idea. But then people don't like me as much because I have to tell them that they have a tax bill to pay at the end of the year. So it's really important to look real closely at your W-2s. Go to the IRS, irs.gov. This is the link. But if you go to irs.gov and do W-4 calculator in the search bar, there's this huge spreadsheet that they walk you through, and you can really review to see if you've had enough withholding out on that. Okay. Now, the biggest, greatest Yahoo moments that when I was reading the tax law, it's like, seriously? We can do this? This is so good. This is the new qualified business deduction. I used to call it the 20% thing. But whatever your bottom line is in your business, multiply that profit by 20% and it's a tax deduction. Boom, just like that. Yes?
I heard there was an IRS finding about 2 weeks ago saying that real estate investors not use that. Is that correct?
I was in a seminar. That's my next slide. So let's pause on that because I've got a big question on that. You're on it. But the 20% of the business net income multiplied by 20%. Now, C corporations, if you're a C corporation, you cannot take that deduction. It's only for pass-through entities, like sole proprietorships, sole member LLCs, LLC partnerships, and S corporations, just those returns that flow through to your personal. If you qualify for this deduction, and qualified is the key word there, then you get that 20% tax deduction. So what does it mean to be qualified? let me re-emphasize this a little bit. Pass-through deduction, it's 20% of your business net income. If you do qualify, whatever that bottom line is, multiplied by 20% is a tax write-off. If you earn for single taxpayers $157,500 or more, this deduction is limited or gone completely. Married filing jointly is $315. So earlier in the presentation when I said watch those two numbers, that's the key number that you want to strategically keep your income below by either maximizing 401ks, putting in IRAs, maximizing your deductions. Getting your income below that $315,000 mark will really help tax situation. So, what is a qualified business? And that's exactly what you were talking about. A qualified business is every business except for health professionals, lawyers, accountants. If you're a pro athlete, performing arts, financial and brokerage services. Now, these are specifically identified in the tax code, but it also includes the word consultant. A lot of us are consultants. That's a very vague description. What's interesting is when the law first passed, it included engineers. And the engineers were excluded from taking this 20%. And they're only excluded if it's over the $315,000, okay? But engineers used to be on the list, but they're not anymore. So I'm just gonna change, I'm not an accountant anymore, I'm a tax engineer. How's that?
Better change the heading of the presentation.
Yeah. Okay, so what about us? What about real estate professionals? Are we qualified or not? Well, real estate agents are not limited to the limitation for the 20% deduction because they're actually selling a product. Same thing with real estate flippers. They're selling a product. Construction, they're selling a product eventually around that way. Wholesalers are not limited. Real estate coaches are limited. So Tony and I are screwed here. We're double. We're a coach and accountant that we can't take advantage of this situation if our income was over $315,000. Yes.
So if you make $350, you get the deduction of the $315 portion of it? It's not on the surplus?
Excellent question. Yes, at $315,000, he was asking if you made $350, do you get a portion of that 20% deduction? The answer is yes. It is a very complicated formula, but you do get an allocation if you were between $315 for married filing jointly and $415,000, then there's the allocation. But once you hit over $415,000 as married filing jointly, there is no deduction whatsoever for that 20% qualified business income deduction.
It's quite common to have a single member LLC owned by a multi-member LLC. Does each LLC get to take a 20% bite out of the profits?
Each entity has to do the calculations independently. So maybe one entity lost a bunch of money, but then another one gained a lot of money, or
but what I mean is, LLC A makes a profit of $100,000, takes 20% off, but that's owned by LLC B, which is another partner entity, so that's made a profit.
It gets consolidated into one. Yes, yes. But there's a lot of us who have an LLC over here that owns their rental properties, right? And then you also have an S corp over here that you do flips in, or you have another active type business. You have to figure out the calculation independently, and it gets really complicated. It's crazy. I've been in two live seminars and several webinars to try to figure this thing out. It is kind of crazy, but you have to figure each entity independently, and then that calculation goes through to your personal tax return as a deduction.
Where does property managers fit in?
Property managers, they are not listed on that other page as a professional, health professional, lawyers, accountants. So in my opinion, that type of business is qualified to take this deduction.
And investors?
And investors? Well, it depends on what it is that you're doing. If you're renting a house, which is my very next slide, this is the question of the day. Is rental real estate considered a qualified business? Rental real estate, you own several rental properties. Is that considered a qualified business? I was in a seminar 2 weeks ago, and they said, they don't know. There's not an answer. So what do we do? So at the end of the day, they said it's the tax preparer's discretion to say whether their business is qualified or not. In my opinion, and what I've been teaching is you're in business. This is a business. Real estate, owning rental real estate is a business and should be qualified. Okay. Watch for rulings over the next couple, probably 3 months. This will be further defined. Now, you said you heard something? That
2 weeks ago, there was a finding by the IRS saying that no, real estate investors, real estate in general wasn't, but I don't know the details.
They were not qualified, because in the past it's passive activity rules and they fall under advantage rules anyway. But at the end of the day, is it really going to matter? The reason I ask that, Section 179. In years past, Section 179 was not allowed for rental real estate property. Section 179 is you buy an asset and you completely write it off in the full year. Okay? So we were not able to do that in the past. But now, if you replace a roof, replace heating elements, replace the fire protection, security systems, those are things, for example, that you can now take Section 179, depreciate it all in full in the year that you buy it. Not when you first buy the property. When you first buy the property, it's all, as a fixed asset, unless you do what? What is it? Cost segregation. You got it. So, if you buy a new apartment complex, really consider the cost segregation. If your investment is over $1 million. If it's less than $1 million, it's an incredible paperwork nightmare. But if it's over $1 million, that's kind of my threshold. Some other people might say 500,000. Some other people might have different amounts. But my opinion is about $1 million, because then you can write off the roof immediately and have that huge write-off. The problem is you're still limited to passive activity loss rules. So if your income is over a certain threshold, you can't take all the losses anyway. So what good would it be to deduct this whole roof when you can't take advantage of it this year anyway? Now you can accumulate it, and then maybe next year you have a big profit, and then you can withhold the profits. It gets complicated. But one of the things that you can't do in Section 179 is the major renovations to your property. How am I doing on time? Okay. Expansions of buildings. So if you buy a building and you rehab it, all of that rehab cost needs to go into the basis of that property, and you depreciate that property. And then when it's placed in service, and now you've completed all the rehab, and now you need to replace those appliances or something, then that can be subject to the 179, and you can write it completely off in the year that you purchase it. But now there's something more. So now, special bonus depreciation, and this is bonus depreciation on any kind of business, not only real estate, but real estate can participate in this bonus. For any asset that you purchased, other than real property, the house itself or the apartment complex itself, any asset that you purchased after September of 2017, you can deduct 100% of that cost. So it's the same thing as the one section 179. So you can deduct 100%. So all these things that used to be required to capitalize these expenses and been depreciated over time, you can now take it. So that's why I go back to the point is, even if they disallow the qualified business income for you guys, your income is going to be lowered because of this bonus depreciation and the Section 179. After 2022, it's going to phase down. It's going to go to 80%, then 60%, and then down to 20% in 2026. By that time, they're going to be passing new laws, so who knows what's going to happen then, right? So the big question is what do we take? Bonus depreciation or Section 179? It really does the same thing. It allows you to take 100% of that expense and deduct it. But the thing about the bonus depreciation, if you have assets that are in the 5-year class or 7-year class, you have to take all of the items that you placed in service and take a bonus depreciation. And where Section 179, you can take bits and pieces. So you can choose that this property you want to take Section 179, but this one is losing money, so you don't want to take it. You don't want to accelerate the depreciation on that. So I know that gets kind of complicated. So which way do you go? It's a lot of, juggling the numbers, figuring out, what if scenarios on which way to go and figure out what's the best tax advantage for you. Not only this year, you got to think about this year, but what's going to affect you for next year and the following years after that. So that's what you've got to, kind of evaluate. And speaking of which, cars. Where in the past, it used to be where you had to buy a vehicle over 6,000 pounds or an SUV or a truck to get that bonus depreciation of $25,000 that you can write off on your tax return for buying a business use vehicle. I want to emphasize that. So if your business owns the vehicle 100%, you can take 25% or $25,000 if it was a truck. But now they've expanded it. You can buy a car and accelerate the depreciation and take $10,000 the first year for any kind of car that you want. So the second year would be a $16,000 write-off. Third year would be $9,600, and then $5,740 in following years after that. So this deduction is 3 times higher than you would have been able to take in 2017. So it's an additional write-off. So the next question is, do we take the depreciation on our vehicles, or do we use the mileage method? And that has always been a big topic, is do we take mileage or do we take actual expenses? The actual expenses would include the depreciation that you're taking, plus all the repairs and maintenance on your vehicle. If you take mileage, it includes the depreciation. Okay? So my general rule of thumb is if you have a partial use vehicle, it's better to take mileage on that partial use, because what's going to happen is the 4th and 5th year, now that depreciation is all out, the 4th and 5th year that you own your vehicle, you don't have a tax write-off. So that's something to think about. Now, if you're one that likes to buy a car every 3 years, take advantage of the depreciation. But if you like one that keeps your car for 5 to 10 years and then get a new vehicle, it's better to take the mileage method. And so I also have mileage logs up here. If anybody wants mileage logs, grab one from me. Or we use an app called Mileage. Well, I use Mileage IQ, or there's Trip Log, or there's several of them out there. But make sure that you keep track of your mileage, because that's a huge write-off. This year, for every mile that you drive, is 54.5 cents deduction. So even if you drove here and you only drove 10 miles, you've got $5.40 right there, right? So it's a big write-off. And I prefer the mileage because you still have to keep track of your business use of your vehicle anyway. Yes.
On, let's say, the $10,000 appreciation.
Uh-huh.
How does that, say I make $100,000.
Mm-hmm.
So that $10,000, how does that figure in writing off my income? It doesn't come off my $100,000 to make it 90, does it?
It does.
Oh,
it does, yes. So if you had $100,000 other income, you had depreciation of $10,000 for your car that you just bought. Income now is $90,000. Your taxable income is now $90,000. Yeah. Now take that $90,000, multiply it by 20%, and you got even more. So yeah. Also, in this new tax laws that were passed, when you buy computers and printers, they just said write it off. No longer putting it into your asset schedule. So just write it off. It's like, okay. So I just put it into office expense. All your computers and printers and software, just write it off. Okay. This is what I expanded on a little bit earlier. The Section 179 can be used for real estate investing now. This is kind of a repeat, but when you buy refrigerators, stoves, air conditioning units, it can take Section 179 on that. I think we talked about that before. Net operating losses. Some years we have a bad year, right? Sometimes it happens where you have a bigger expenses than you have income. You have a net operating loss. And it used to be if you have a net operating loss, then you can amend your prior year's tax return and apply that loss into prior years and then get a refund. But now going forward, we can take that net operating loss and carry it forward only. But the problem now is you only get 80% of that. So the new law is it only can offset 80% of the taxable income versus 100%.
So if you had $100,000 in income, or you had a net loss of 100, so that means you can only take 80. But can you only take that 80 for next year, or can you take partial next year and then maybe the next year take a little bit more?
It has to all go into the next year. You can't split it between future years. You have to take it all in the following year until it's used up. So let's say next year you only made $50,000. So the following year you would carry the $30,000 difference into that third year. So yes.
So if you had previous losses, does that still knock down to 80%, or is that only on new losses?
It's only on new losses. Yep, good question. Good question. Okay.
So in other words, the 80% applies to the profit in the future year, not to the loss that you've made.
Correct.
Right?
Correct.
So if I've lost 100,000 this year, I can reclaim that 100,000 next year or over the next 5 years or whatever, providing that it's only 80% of the profit I make.
I'm not 100% I'm following, but
if I lose 100,000 this year and I make 100,000 next year, I can only claim 80,000.
Correct.
But I'll still have the 20,000 left for the following year.
No, you lost it.
So it's 80% of the loss,
yes.
not 80% of the future profit.
Correct. Yeah.
That's fine.
Yeah. S corporations. I'm doing a huge presentation just on S corporations here in a couple weeks. But if you guys, or how many S corporations do we have in here? Wow, a lot. A lot of S corporations. Good. S corporations are my favorite. But you have to be very, very careful because you can manipulate your income, right, to lower your salary to increase the qualified business income, right? That's a good tax strategy. The IRS will be on you in seconds. They are going to watch the S Corp salaries very, very carefully. Because as an S Corp owner, you have to have a salary if you're profitable. If you don't have profits, then you don't need to do a salary. But if you reduce your salary this year, and you've been doing the same thing, for 10 years, and you reduce your salary this year to take advantage of that, they have Aguilar's or formulas, in their program that will watch for those things, and they will send you a letter, and then they could disqualify your S Corp. So be careful with that. Make sure that you pay, quote, a reasonable salary. So what's the definition of reasonable salary? Nobody knows. Nobody knows. There is a company called RC Reports that is actually local here. And if you really wanted to know what should your salary be, their reports, they can do an analysis and say, okay, you spend X amount of your time doing this thing that is worth so much dollars, and then you take out the trash in your office, and so that's janitorial wages, and so that goes into the formula. And then they can figure out how much your wage really should be, and that will hold up in court, in tax court. Yeah.
This is for legal S corps and LLCs taxed as S corps?
Correct. Yeah, LLCs taxed as S corps. Yeah. So just wanted to really emphasize that and make sure that you don't play too many games there with your S corp salaries. And then in summary, the average real estate investor will be paying lower taxes on average. The new tax law encourages more flow-through income, more rental income, but then you can depreciate it with the bonus depreciation or the Section 179. And it also encourages you to buy assets. So for us real estate investors, that's the biggest takeaway. But watch legislation to watch for that real estate, rental real estate ruling.
Follow up on the question of the qualified 20% off for real estate investors. I noticed you had a little box at the bottom saying that qualified or real estate professionals qualified as real estate reduction.
Yes, because if you're a real estate professional, it's an active business per se, and therefore that would qualify as a QBI income deduction.
So what would be the drawback of declaring ourselves as a professional?
None. Because the benefit is that you can claim a loss. If you can show that you have 750 hours in your real estate business, you can claim that you're a real estate professional. And what that does is if you have a losses of over $25,000, you can deduct that. No. It gets complicated. So is there any other questions? I'm sorry that I kind of overloaded you with so much information. Oh, sorry.
Can you rewind back to the last, what you said about 25,000? So for real estate professional.
Yeah, if you are a real estate professional, you can claim up to $25,000 losses on your real estate. If you're not a professional, then you're limited to $3,000. And this is subject to certain thresholds of income. So if you're over a certain threshold of income, then you're limited to the losses that you can take on your real estate.
So if you have $8 million worth of real estate, you lose $200,000, you can only deduct $25,000.
Correct. Well, no, it depends. It depends on your income level. It depends on various other situations that you're in. So that one is a very in-depth question that I would advise just talk with your tax professional, because they'll have to, each scenario is different. Every person in this room has a different tax situation, so it's more of a general statement that I need to pass on. But there's a lot of new information. This is a lot of new tax laws and a lot of what I call gameplay of figuring out, should I do this or should I do that? And if I did this, what would this be? So it's a lot of crunching the numbers. It's not just filling in the forms anymore. It's really figuring out what way works best for you. Okay? By figuring out, how much tax deductions to take, and if I take a loss on this month, this business, then the qualified business income will increase or decrease. What would be the effect of that? So tax planning is incredibly important this year, of course. So, any other questions?
Secure tax engineering and tax solutions.
Yes, secure tax engineering services. So I guess I'll turn it back over to Adam then.
One more question.
Oh, another question, sorry.
Is this going to be your slide presentation? Is that available to us? Would we be able to get a hold of it?
It is. I don't release the slides, but I think you're going to have a follow-up.
Yeah, so I have a YouTube channel, and you can find almost every presentation that we've done on that YouTube channel just by searching the name and the presentation. So it usually takes us 1 or 2 weeks normally. He thinks 1, sometimes 2, and that's usually my fault because I have to record an intro. But yeah, it'll be up within 2 weeks.
Thank you.
Fellow, is it true that real estate professionals have a higher audit rate?
I have not heard that.
Okay, thank you. Let's hope so.
So, just continue to watch for legislation that comes through the pipeline on that real estate professional status.
There's one interesting thing, and I might have been out of the room about real estate professionals, so I just want to bring it up and bounce it off of you. I heard that to be qualified as a real estate professional, there's a certain way that you want to structure things, because if you have multiple LLCs, there's some way that they'll make you prove that you've done like 300 hours in each and every single one of those LLCs. But if you structure it a different way, then you can have all of those LLCs flowing to one place, and now all you have to prove is that you did 300 in that main LLC.
You would have to do 750 in that main
750
LLC.
in the main one. But if you have like 10 different LLCs and they're all unique to each other, you have to somehow prove that you've done that much work in each and every one of them individually.
Right.
Which, if you have 20 LLCs, nobody's awake that many hours, so it'd be impossible. So anyway, just something to think about. Give her a big round of applause. And she's got cards, she's got flyers.